So, for today's show, we're not going to talk about some of the usual things we talk about, like the stock market, which is clearly in a bear market, and every time it goes up is a definition of a bear market rally or a dead cat bounce, as we see all the bloody hands on Wall Street still trying to catch that falling knife. We're not going to talk about the bond market, where the 10-year Treasury is above 4% again, and the yield curve is upside down, literally, which the longer this yield curve stays upside down, the odds of the D word, depression, become greater. We're not going to talk about the housing market, where mortgage rates at this point are not conducive, not that affordable, and not that palatable by the consumer. What we're going to talk about today is an event that could happen that might fix all of this. Unfortunately, that event's going to have to be a bad event for some good things to start happening. This event could be the collapse of the Bank of England, where this could be the job being finished that the ill-advised Brexit of 2016 started. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. Hope you're having a great week. Okay, so I've been saying for the last few weeks that we are living in an event-based global economy, and I think something's going to break, and I think I might have an idea, just a guess on my part, because this is, of course, the theory of economics that we discuss, not the perfect science of economics. I think this event could be the collapse of the Bank of England, which is the equivalent of our Federal Reserve Bank here in the States. So, this event, I believe, did not just start recently. I believe this event started the ball rolling in 2016, where the ill-advised idea of the Brexit from back then actually caused global rates to drop because of the uncertainty that this Brexit that was voted on and passed, but then I don't even know the status of it for that matter, but I knew it created a lot of uncertainty that our friends across the pond are dealing with now. They have broken debt markets in England right now. Their debt markets are broken. Their central bank does not have control of their economy. On one hand, they're going to do some quantitative tightening, and on the other hand, they're doing some stimulation by buying some of their own stuff over there. So I think that this is the contagion that is going to happen when the Bank of England, which I think the odds of them collapsing are now above 50%. This might be the first time you're hearing some of this. This is obviously the first time I'm saying it here in front of everybody. But the odds of the Bank of England collapsing, I believe, have to be over 50% at this point. And this will create this contagion, which for us old schoolers is a word from 2008 and 9, of spilling over into other economies, because as we all know, the global markets and economies are connected. So if the Bank of England collapses, our Federal Reserve will then, unfortunately for the Bank of England, find the cover they need to stop this absurd rate raising into the face of the R word, which we are clearly in, which is a recession. So, here's my advice, short and sweet. The Federal Reserve should look at the Bank of England right now, recognize the Bank of England doesn't have any tools left because they're using their tools to counteract each other, and at some point there's going to be no more counteracts. There might be no more acts because we're probably going to have to go in with some other countries and bail out the UK if nobody believes in their economy and nobody will buy their treasuries to help them stimulate things, for example. So, Bank of England's out of tools. Federal Reserve, let's just take a look at them. Let's not be out of tools. Let's learn from the Bank of England. They should heed these warnings. Federal Reserve, you need to stop. You need to stop before you exacerbate the recession, and you need to stop before you bring on a depression. Because anybody that works in finance right now understands that this payment inflation that's happened has way outdone itself to any price inflation the Federal Reserve is trying to fight. So, short and sweet today, the show. Federal Reserve, take your cue from the collapsing Bank of England. It is time to stop raising rates, or in about a year from now, you may be dealing with the D word, which is depression, which the only way to get out of a depression is to lower rates and print money, which may not happen based on how much easy money bothers you at this point as a central bank. So, that is my show for this week. Nothing about anything but the potential event for a calamity, which could be the downfall of the Bank of England, which will cause contagion. And the Bank of England might just take one for the team, meaning the global economy in the long run might benefit because it might get all these central banks off this absurd economic policy of tightening into a slower economy. Okay, everybody, that is my show for this week. I hope you enjoyed it. As always, if you have any mortgage-related questions, please don't hesitate to reach out to me. Thank you as always for watching, and have a great, safe weekend.